Americans know Zillow, Germans know Scout24, or rather known here, Immobilien Scout. Scout24, I'm gonna pronounce it for now in English so you don't have to listen to my German all the time, operates as the digital hub for real estate in Germany. They really only have one competitor in Germany, Immowelt, and they're not as strong as them. The stock has performed very well over the last few years because they have turned their business around, and if you're a renter or real estate agent in Germany, especially in the beginning, there's no way around their platform. Scout24 operates as a holding company for the different companies. Scout24, they are the leading real estate operating company in Germany and Austria. They're basically the Zillow. You list real estate there either to rent or to buy. FlowFact is a CRM company, including with PropStack. They're basically slowly becoming one company. They're a customer relation management tool for real estate agents. I work in a real estate department. I don't work as a real estate agent, but I use the same software and it integrates everything very well. There's nothing else on the market which beats it. It manages your customers, their properties, the requests you get for the properties, and it's really a fantastic tool and it's becoming more and more well known. Vermieter.de, it's basically a management company for landlords. Immoverkauf is kinda like ImmoScout. Baufi-Team, it offers finance comparison, so where you can get your mortgage. They make a bit of money there, but it's very high margin. Sprengnetter, they're the leading company in the department. They have data from all across Germany about sold real estate. And a lot of people use it to value property, to look at data, because they have the most data around. They also offer access to documents that you would need for a sell. Now, all the other ones are fairly small. Energieausweis 48 is becoming a fairly big part. Basically, in Germany, you're legally mandated to show how energy efficient your building is. It is complete horseshit, but it's mandatory. It is extremely high margin. Basically, people just enter a few things, some data points, they slap their seal on it, and they charge you 100 euros. So it is extremely high margin. All of these businesses are very high margin, low input. The biggest inputs you have are Google Ads, and we're gonna come to ImmoScout again for that. Now, this is their main product, ImmoScout. How do they make their money from it? One, you can pay money to be listed higher. They make a lot of money, especially from real estate agents for that. We're gonna come to that later. That is a smaller, continuous subscription revenue that they get. But however, what is the most important thing is this. They advertise themselves on Google, and also just because they're so well known, you wanna sell your property? Just click a few things, we're gonna give you a rough value. Now what happens after this? We finance the service for a commission of our real estate professionals. You enter your data. For example, my name is, I don't know, Schmitz Franz. I have an apartment, it's roughly worth this much. At least that's what the data tells them. This is my phone number, this is my email address. This is called a lead. They generated this lead. And now what do? They sell this lead for multiple hundreds of euros to different real estate agents. There's a cap on that. And now what happened? They turned maybe a Google ad, which they paid maybe 30 bucks for in total to acquire. Let's even say 100, into 6 times the amount for no effort. They sold it to real estate agents, no risk there, so that is extremely high margin revenue. And especially as a new real estate agent, you don't have a choice but to go for them. Because no one is gonna be like, oh yeah, I sold my house via this guy, if you haven't sold many houses from them yet. That is the transaction enablement revenue. That is growing at 14%. Now, other stuff is the subscription revenue, because if you wanna be shown as a real estate agent there, if you want the property you sell to be shown higher up, you need to pay subscriptions for that. Now, there's a mix between both of those, because there are different classes where you pay different much, the price of leads get reduced. So this is kind of a mix. Both of these intermix. So I look at the professional revenue overall. And that is growing at 15% year over year. They have margins of 74% here now. That is dream margins because they have no risk here. Now, they also have private revenue. This is, of course, one, people paying to list their own homes there. They take small fees for that. But a lot of what they get here is the subscription revenue. You don't have this as a private landlord, really. This is for renting, because so many real estate markets in Germany, just like in America, it's so hard to get a rental. Then when stuff gets listed on there, it gets sent first out to Scout Plus members. If you live in one of those high demand markets, you know that apartment, if it is at an okay rent, even slightly higher than normal, because you're willing to pay your soul for a new apartment. So then you see, you can either choose a 3-month subscription at 29 euros a month, 6 months at 19.99, or 12 months at 12.99. Just to be able to at least get an apartment, maybe in these markets. So they're squeezing even renters there. Now, sadly, they don't have all the data here. They sold off some businesses here, especially in 2022, for some cash. And now it is basically only the real estate platform. and has worked out very well for them. Just remember, all these dips downs are them selling parts of the business. And now they're sitting at operating margins, growing and growing, hitting 50% operating margins with virtually no net debt. This is the cash they raised from the sale of the businesses. They have used that to buy back a lot of shares, and they're now paying out an okay dividend. So what you have here is really a monopoly in the German real estate market. They have the cash and the power to expand all over the neighboring European countries. And they're already acquiring other real estate companies like Fotocasa and Habitaclia in Spain. Now this is gonna slightly decrease their margins simply because they're integrating huge businesses. They have the gigantic amount of cash to grow here. They're already growing at 17% adjusted. That is because they had a one-time tax refund here. You should look at the adjusted net income. They're growing at 17% there. And they're still expecting to continue to grow at 14 to 15% revenue. So that even more in EPS long term, and they're growing earnings per share at 20%. Now they take share-based compensation on that, but there's 1 million in share-based compensation. That is basically nothing. Now, if we take this adjusted earnings per share for this quarter and multiply it by 3.5, now why not by 4? Simple, because Q3 is usually the strongest quarter for real estate, combined with Q1. That would give us 3.15 in earnings per share. Now we can already see that is a fairly high multiple for a company, but it's getting that high multiple because it's so high margin, so low risk. Even if the entire real estate market freezes for multiple years, they will not go bankrupt because they don't have high costs. If transactions slow down, great, there goes the revenue for a bit, but they're not gonna starve. All their costs are basically just Google ad costs. They have some running costs, but mostly ad costs. Now let's put in these numbers and see what we're gonna come up with. If we take in these numbers, 3.15 in earnings per share, what if our growth rate's gonna be? They're currently growing revenue at around 15 to 16%. Especially with the Spanish acquisitions, I just assume they're gonna go internationally more, looking for small acquisitions back. And I think they're gonna be able to increase margins in that Spanish business overall. So I think in the long term for the next 5 years, they're gonna grow at 17% earnings per share, including 1 to 2% buybacks. Afterwards, slight slowdown, 15%, terminal multiple of 18. It's basically a duopoly in the German market. And of that duopoly, it's the bigger one. I think they can extend that towards all of Europe. I'm just going to assume they pay out 50% as dividends because they just have so much cash. It's such an asset-light business. They barely need to invest money in the business, so they can give it all to shareholders. Then we'd come to a value of $103 a share, 16% upside from where it is today. With this calculation, we would assume it's a good buy. However, it recently just got into this range. 2 years ago, it was definitely in a good buy range. Sadly, we didn't spot this earlier. Now, what if it goes even better? 20% growth. I don't think this is gonna happen. To keep up this growth this high for that long, maybe if rates drastically drop, the market heavily inflames again, because you gotta remember, they're doing these growth rates while the market is super slow. They don't care about the price, they make money on how many transactions there are. So maybe if rates drop back to 0 in Europe over the next 2 years somehow, then we come to this one. 20% growth, 17 and 20 multiple. Then this is a fantastic buy. However, what if it slightly cools down? Not even a lot. Basically, we reach peak revenue growth and it slowly ebbs out over time. 15%, 12% afterwards, 50 multiple, $75 a share. Actually, euros. I'm sorry, this is all euros. So not even a big downside. So overall, I think Scout stock is definitely very, very interesting. I'm adding it to my list. If it falls any further, I will probably consider adding it to my portfolio. Very stable company, very high margin, with a fantastic position. What do you think? Write down below. Have a good day.